This week on the Fundamentals Report, we look at one industry sector that will noticeably outperform the cannabis green rush. Investing in high growth trend is proven to be one of the best ways to build wealth, and although the cannabis sector has proven successful for many investors, there is one industry sector that is set to significantly outperform cannabis. This same sector is the focus of giants such as Google, Facebook, Microsoft, and innovative content and technology leader Real-Time VR, trading as RLTR. Virtual reality is the highly disruptive technology which is quickly becoming part of all consumers' lives and will impact almost every major industry sector. Over the next few years, VR will begin to realize its potential with an estimated 171 million active VR users, generating nearly $121 billion in sales. For more information on VR and other stories, visit thefundamentalsreport.com.
Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered. Hello and welcome to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I am your host, Sarah, and we are here to talk about news from the world of finance. We're going to start with what happened on the stock market today. It is Tuesday, January 28th, and the Dow jumped 187.05 points, or 0.66%. to 28,722. The S&P 500 gained 1.01% to end the day at 3,276. The NASDAQ composite climbed 1.43% to 9,269. Stocks recovered from their worst day of 2020, regaining a good chunk of those losses, but concerns over the coronavirus linger. Stocks rebounded as the continuation of the earnings season and stronger than forecast consumer confidence data offered a positive counterbalance to the uncertainty around the coronavirus. Still, investors keep vigilant watch on any developments around the sickness. Earlier today, CNBC reported the White House was considering implementing travel restrictions on China. Meanwhile, the Center for Disease Control and Prevention said travelers should avoid all non-essential travel to China. Apple shares jumped 2.83% ahead of the company's quarterly earnings being released. Goldman Sachs also contributed to the market's gains, rising 1.86%. Investors are still monitoring the spread of that coronavirus around the world, but several other news events could move the markets tomorrow, Wednesday. Here's what you need to know. The Federal Reserve will discuss its first meeting of the decade on Wednesday. Investors will likely be looking for signs of how global growth and the coronavirus outbreak may influence future rate decisions, and for any hints of operational changes by the central bank. The market also will pay close attention to Fed Chair Jerome Powell's speech and what he says about the Fed's repo program. The central bank has been active in the overnight funding market since September, leading the rapid buildup of its balance sheet as it tries to keep overnight lending rates stable. The main interest rate is widely expected to hold steady in the near term at a range of 1.5% to 1.75%. Traders have priced in an 87% chance that the benchmark interest rate will stay the same on Wednesday, according to the CME's FedWatch tool. Boeing earnings. The beleaguered aerospace company has welcomed a new CEO, pushed back its tentative projections for the return of the 737 MAX, and secured over $12 billion in financing from banks in just the last month. Vertical Research Partners downgraded the stock from buy to hold last week, with analyst Robert Stollard saying in a note to clients that the quarter was nearly guaranteed to be a, quote, an absolute disaster. Stallard said Boeing's fourth quarter results will give the company a full year adjusted loss of $5.44 per share and $81.482 billion in revenue for the year. That translates to an adjusted loss of $4.26 per share for the fourth quarter alone, according to FactSet. Another key consumer company reports results tomorrow is McDonald's. McDonald's will announce its fourth quarter earnings before the bell. KeyBank projects the fast food company will post $1.99 in earnings per share and 5% growth in same-store sales for the fourth quarter. KeyBank has an overweight rating on McDonald's. The earnings call may also provide more information about menu changes. The company announced Tuesday that it is adding 2 new chicken items to its breakfast menu. The company's stock tumbled last fall, but is up roughly 7% since the beginning of November. Notable times. Note that all of these times are Eastern Standard Time. 8:30 a.m. preliminary wholesale inventories. 10 o'clock pending home sales. 2 o'clock FOMC decision. At 2:30 Fed Chairman Jerome Powell briefing. Major earnings, Boeing before the bell, McDonald's before the bell, all of these before the bell, General Electric, Marathon Petroleum, AT&T, MasterCard, Microsoft, and now we are after the bell, Facebook, Tesla, PayPal, and Mondelez. Here is a look at companies making headlines after the bell. The first is Apple. Apple stock rose 2.5% after it reported strong fourth quarter results that beat analysts' estimates at the top and bottom line. The results were powered by iPhone revenue and Apple's service businesses like Apple TV Plus and iCloud. The company reported earnings of $4.99 per share on revenue of $91.82 billion, while analysts expected earnings of $4.55 per share on revenue of $88.5 billion, according to Refinitiv. Starbucks in shares of the coffee giant dropped more than 1% after the company announced the closures of all cafes and deliveries for locations in the Hubei province, where the coronavirus originated. The company beat earnings estimates by 3 cents per share, excluding some items, reporting quarterly profit of 79 cents per share. Revenue came in slightly below Wall Street forecasts, according to Refinitiv. eBay. Shares of the e-commerce giant dropped more than 5% in extended trading after the company reported strong fourth quarter earnings, but offered weak first quarter revenue guidance. The company reported earnings of 81 cents per share, excluding certain items, on revenue of $2.82 billion, while analysts expected earnings of 76 cents per share on revenue of $2.81 billion, according to Refinitiv. Advanced Micro Devices. The semiconductor company stock dropped more than 4% in extended trading after the company reported strong fourth quarter earnings, but offered weak first quarter revenue guidance. The company reported a quarterly profit of 32 cents per share, excluding certain items, compared to a consensus estimate of 31 cents a share, according to Refinitiv. Fourth quarter revenue beat Wall Street on analyst estimates. And Alaska Air. Shares of the airline dropped and then returned to around the closing price of $65.54 in extended trading after the company reported earnings and raised its quarterly dividend by 7%. Alaska Air reported a fourth quarter profit of $1.46 per share, excluding some certain items, compared to a consensus EPS estimate of $1.41 per share, or $1.41 according to Refinitiv. Revenue came in slightly above Wall Street forecasts. Let's go ahead and take our first break of the podcast. When we come back, we'll be talking about what to look for in the coming week. So stay tuned. You're listening to the GSMC Financial News Podcast, and I will be right back. This week, we take a look at what is considered by many to be the next extreme high growth sector, quickly becoming part of all consumers' lives and beginning to impact almost every major industry sector, is virtual reality, augmented reality. predicted to bring us the most disruptive technology since the cell phone and impacting a wide array of core industries, including entertainment, healthcare, education, retail, military defense, marketing, manufacturing, and media. Nearly every major player in the technology space have invested heavily in VR/AR. This includes the top social media company Facebook's purchase of Oculus for $2 billion. Their firm commitment to focus on virtual reality recently launched Facebook 360, which allows all 2.2 billion and climbing active Facebook users to experience and share virtual reality content. YouTube has also invested deeply in VR, now prioritizing VR content over other content to its 1.3 billion active users. And it doesn't stop with social media, as Samsung, the largest manufacturer of cell phones worldwide, has over 1 million users per month on its Gear VR headsets. Sony PlayStation launched VR games on its PlayStation 4 console, as did Microsoft on its Xbox One platform. Other standout tech companies invested include Google, IBM, Intel, HP, Foxconn, and other smaller but notable companies, such as LG and HTC. In fact, 8 of the top 10 tech companies in the world are invested in VR/AR. Whether you've strapped on your favorite VR headset or just seen one of those 360 videos on YouTube or Facebook, chances are you've already sampled virtual reality. From entertainment to educational applications, VR has finally made the transition from science fiction to everyday life, and it is set to massively expand. Per projections from Greenlight Insights, VR is set to reach 171 million active VR users, generating nearly $121 billion in sales in just a few short years. Analysts at top brokerage firms such as Goldman Sachs are aggressively recommending virtual reality stocks, likening the opportunity to the advent of the television. Piper Jaffray described virtual reality as, quote, the next megatech theme, going as far as comparing the state of virtual reality today to that of mobile phones 15 years ago. Investing in high growth trends is proven to be one of the best ways to build wealth. VR/AR can be considered to be the highest growth sector we have seen in many years and is the focus of publicly traded market giants such as Google, Facebook, Microsoft, and Sony, as well as smaller public companies such as innovative content and technology leader Real-Time VR Trading, as RLTR. Do your own research now on virtual reality. Welcome back to the GSMC Financial News Podcast. Before the break, we were talking about the stocks for today. As I said before the break, we are moving on to what to watch this week from the Fed. The Federal Reserve heads into its first meeting of the new decade with its key responsibilities. Interest rates well resolved, but with a slew of other less headline-grabbing but still significant decisions on the table. Practically no one expects the central bank to move its benchmark borrowing rate until at least September. Central bank officials have made it clear that it would take a meaningful change from current conditions to prompt another cut. There's also pretty much no chance of a hike absent a sudden jump in inflation. But officials still will be called on to answer a few key questions, such as what role could the Wuhan coronavirus play in policy terms? How much more will the Fed expand its balance sheet? Is it time for another technical adjustment on the interest paid on bank reserves? Wednesday's rate decision and subsequent news conference from Chairman Jerome Powell likely will provide only hints rather than concrete answers. However, the details of where the Fed stand will be important. At best, they can be patient and wait and see to stay to their original script, which is we're on hold this year, said Lisa Shallett, Chief Investment Officer at Morgan Stanley Wealth Management. If they alter the script, I do think markets are going to be concerned. The intensifying coronavirus spread has gotten the market's attention, both on a human level and the extent to which it could slow economic activity, particularly in China. Past practice for the Fed has been to acknowledge such events but not to react to them. Policymakers generally view things like natural disasters, epidemics, and other exogenous occurrences as one-offs in nature and not a factor in long-term policy decisions. In a November speech before Congress, Powell said it would take a material reassessment of conditions before the Fed would change policy. A China-centered global outbreak of a highly contagious disease with a high fatality rate that threatened to derail tentative global economic stabilization, if that is what we are dealing with, could in principle meet the material reassessment test, though we do not think Powell will get drawn into this type of judgment at this juncture. That is a quote from Krishna Guha, head of global policy and central banking strategy at Evercore ISI. The economy more broadly seems to be fairly steady, with the Atlanta Fed projecting fourth quarter GDP growth to come in at 1.9%. That's not gangbusters, but it's better than the flat growth indicator the indicator had shown earlier in the quarter. As a compromise, the Fed could change the language in its statement about the way it is monitoring international developments. Powell also could give a nod to the manufacturing slowdown. The headline durable goods orders for December were better than expected, but masked weak underlying fundamentals. In addition to broader economic issues, the Fed has been wrestling with the level of bank reserves that the financial system requires. To ensure that banks have, quote, ample reserves, the Feds have been conducting daily and longer-term market operations to allow institutions to exchange high-quality assets for the short-term cash they need to operate, in a process known as repo operations. That has allowed the Fed's balance sheet to expand back above $4 trillion. While the operation ostensibly was aimed at keeping overnight borrowing rates within their prescribed range, it also has coincided with a stock market rally that has almost perfectly matched the balance sheet increase. Some in the markets have been calling the expansion another form of quantitative easing the Fed used to goose the economy during and after the financial crisis. With the Fed only committed to keeping the operations going through the second quarter, cleanly unwinding them could be another nettlesome issue. They're going to be very careful. They attempted to do this in a stealth way, in my humble opinion, for political expediency, Shalit said. I think that to start acknowledging that, we're not going to have to suspend the balance sheet expansion by the middle of the year. Markets are not going to take that well. Powell at times has been less than adroit in how he has prepared the market for a change in approach. This is tricky terrain for Powell, and if mishandled, could be disruptive, Guha wrote. That is why we expect only very cautious and limited comments for now, in particular given concerns of the virus, but see net downside risks on the day. There's also some expectation that the Fed could approve a rate hike, but not the kind that most people generally notice. Instead, the committee might be tempted to increase the interest it pays on excess reserves that banks store at the Fed. The rate is currently set at 1.55%, but could be line for a nudge up to 1.6%. The reason is that the Fed uses the IOER as a guardrail for its benchmark funds rate. Over the past 2 years, the Fed has been cutting the IOER rate as the fund rate has moved to the top of its target band. But since the repo operations began, the fund rate has slipped to the low end of its 1.5% to 1.75% range, currently at 1.55%, same as the IOER. The Fed generally prefers the funds rate closer to the midpoint, so a push higher on the IOER could help make that happen. With jitters over the coronavirus situation, however, the Fed might choose to wait. We do expect an IOER hike over time, but in our view, the cost of waiting is very low, and the Fed would probably like to avoid to possibly needing to reverse a hike. Ebrahim Rabari, Forex strategist at Citigroup, said in a note. Rabari said markets are pricing in about a 50% chance of an IOER increase. Futures traders are further indicating a 58% chance of a quarter-point decrease in the fund's rate by September, rising to 73% by the end of the year. However, the Fed this week likely will assert that it remains on hold for pretty much everything. We think that the Fed will note that even though the outlook for the economy remains benign, it continues to watch risks closely, Rabari said. Chair Powell will remain confident about the outlook, including the prospect for inflation to approach the Fed's target, but also be watchful of remaining risks, including still soft manufacturing sentiment ratings and uncertainties around the impact of the coronavirus. Moving on to the job market, consumer confidence jumps as the job market outlook improves. Consumer confidence in the U.S. grew more than expected in January as the outlook around the labor market improved. Data released Tuesday by the Conference Board showed. The board's consumer confidence index rose to 131.6 this month from 126.5 in December. Economists polled by Dow Jones expected consumer confidence to rise to 128. Lynn Franco, Senior Director of Economic Indicators at the Conference Board, said consumers felt more confident about their job prospects moving forward, lifting the overall index. Optimism about the labor market should continue to support confidence in the short term, and as a result, consumers will continue driving growth and prevent the economy from slowing in early 2020, Franco said in a statement. The data released showed 49% of consumers think U.S. jobs are, quote, plentiful, up from 46.5%. Those saying jobs are, quote, hard to get decreased from 11.6% from 13%. U.S. stocks ticked higher following the data's release, with the Dow Jones Industrial Average trading around its session high. We're going to go ahead and take our second break of the podcast, so stay tuned. You're listening to the GSMC Financial News Podcast, and I will be right back. Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings-on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand. Welcome back to the GSMC Financial News Podcast. We are turning our attention now to events that stunned many on Sunday. Early Sunday morning, the world learned of the death of Kobe Bryant and his daughter Gianna, along with 7 other people in a helicopter crash in Calabasas, California. And that prompted a run on Kobe Bryant gear. And so if you are hoping to get some, probably good luck with that. The late NBA All-Stars Lakers jerseys, Nike sneakers, and similar paraphernalia have been flying off of virtual and actual shelves ever since Sunday. ESPN had reported on Monday that Nike was pulling Bryant-related merch off Nike.com to, quote, limit resellers' abilities to stockpile an inventory of existing products, only to sell them on the secondary market at elevated prices. But the athletic apparel giant confirmed to MarketWatch over email on Tuesday that, to the contrary, Nike's website completely sold out of Kobe Bryant sneakers and merchandise. I'm not surprised his products sold out, as Nike would not have stocked a huge amount. Matt Powell, the NPD Group's sports business analyst, told MarketWatch via email, as Bryant's sneaker sales were well behind active players like LeBron James and Kyrie Irving. But then again, he added, we've never had such a high-profile product endorser pass at such a young age. Many grieving sports fans reported that local and online stores were cleared out of Mamba merch, although the NBA's online store still has the iconic purple and gold jerseys for $300, as well as commemorative plaques starting at $29.99 and a life-size removable wall decal for $99.99. The Los Angeles Times special Kobe Bryant edition dedicated to its hometown star also sold out on Monday. It's available on back order for $15 and will ship in the next 2 to 4 weeks. Searching for Bryant's products on Nike's website now directs potential shoppers to a purple and yellow Nike gift card with the Los Angeles Lakers logo or the company's statement in response to Bryant's untimely death. The pair have had a long and lucrative partnership. Nike signed a 4-year, $40 million contract with Bryant in 2003 when he was 24. Bryant teamed up with Nike to establish the Mamba League Kids basketball program after retiring from the NBA in 2016. And his sneaker line with Nike is one of the top-selling in basketball history, Sports Illustrated noted, with many active NBA players like Lakers forward Anthony Davis and Houston Rockets forward PJ Tucker wearing his designs. While Nike shot down the claim that it stopped selling Kobe gear to prevent profiteering, other stores have openly taken steps to prevent it. The Denver-based Vice's sneaker boutique has taken all Bryant merchandise off its sales floor, and Vegas-based sneaker reseller Urban Necessities is also taking action to prevent people from cashing in on Bryant's death, Complex reported. Indeed, pairs of Bryant sneakers that were being resold for $200 on consignment platforms like StockX skyrocketed overnight to upwards of $1,200 after his death. The Observer reported that by 10 a.m. Monday, there were 65,147 pieces of Bryant memorabilia listed on eBay, or about 14,000 more items than 12 hours before. A search at 2 p.m. on Tuesday showed more than 63,000 pieces, including an autographed 1996 Topps Chrome Kobe Bryant rookie card for $1 million. So Urban Necessities owner J.C. Lopez sent a letter to his consigners stating that, quote, we will not allow price changes on Kobe items that are consigned. If you have increased prices on Kobe items, we will be reverting the price back to the original listing price. And in a comment on an Instagram post, which is owned by Facebook, Lopez wrote that this kind of price gouging in the wake of a tragedy is, quote, not how I built my brand or how I need to make a dollar. And now our last story of the podcast is one that is near and dear to my heart because it involves books and it involves libraries. And we have now learned that more Americans are booking it to the library than going to the movies. I'm very proud of you, Americans. Good job. More Americans hit the books versus the box office last year, according to a new Gallup poll, which found that people made roughly twice as many visits to their local library in 2019 as they did going to see a movie in the theater. The nationwide survey of more than 1,000 adults conducted in early December 2019 found that the average U.S. adult made 10.5 trips to the library last year. Going to the movies was a distant second with 5.3 trips on average, and attending a live sporting event was third with 4.7 trips. Catching a live music or theatrical event, 3.8 trips, and visiting a national or historical park, 3.7 trips, rounded out the top 5. And I'm just going to interject here to say that I made way more than 10.5 trips to the library last year. Probably averaged at least once a week, so that's about 52 trips to the library as opposed to the 0 trips I made to the movie theater last year. Yeah, it's been a while since I've gone to the movies. Very sad. The least popular pastimes included going to the zoo, which averaged just under 1 visit on average last year, and visiting an amusement or theme park, which averaged 1.5 trips. The study noted that young adults ages 18 to 29, women and low-income family were most likely to frequent libraries. The library is stacked with free and low-cost resources, after all, including Wi-Fi. Besides borrowing books, music, and other media, including ebooks and digital entertainment, people can also use computers and printers to conduct research, do homework, or apply for jobs. Many libraries also offer classes and training for adults and kids, including computer literacy, foreign language skills, yoga, and meditation. These tax-funded community centers also provide tax forms and tax preparation services. So if you think that there is nothing for you at the library, you would be incorrect. You would definitely be incorrect. In comparison, the average U.S. movie ticket cost $9.16 last year, according to the National Association of Theater Owners. But booking a recliner leather seat can run $20 or more a piece at places like NYC and LA. And this is all before factoring in snacks from the concession stand for another $15 to $20 easily. Before you know it, a night at the movies for a family of 4 has hit close to $100, if not more. So there you have it. The movies, they're fun, but they're expensive. The library, not so much. That's all the time we have. Thank you so much for joining me for the GSMC Financial News podcast. Join us again for the next episode. In the meantime, if you can follow us on social media, that would be awesome. If you can share our posts, like our posts, etc., that would also be awesome. But even more awesome if you could subscribe to this podcast and give us a lovely rating. We would very much appreciate it. So thank you again for joining me, and join me again next time. You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.
Meet Bob. Bob's a business owner with the next great retail product and is ready to market his product to the entire U.S. consumer market. Problem: Bob spent all his money developing and making the product and has no money to pay for advertising. Bob's bank says, go sell the product and then we may loan you money. Venture capital sharks want a majority percentage of Bob's company. Bob's not happy. Now meet Sue. Sue is celebrating the sale of her millionth unit on TV. She was also turned down for a loan from her bank, but she contacted Media Funding Group to fund her advertising campaigns. Media Funding Group provides funding exclusively for advertising campaigns using equity participation and revenue share models that, unlike bank loans, you do not have to pay back. If you have a great product or service and all you need is funding for a major advertising campaign, don't be a Bob. Contact Media Funding Group today. MediaFundingGroup.com.